If you switch jobs, there is one curveball you may not be expecting, and it has to deal with contributing to your retirement account. I'm going to help you with that so you avoid this mess. That more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. When you switch jobs, there's obviously a lot of financial changes going on. Likely a change in your wages, maybe change in your salary, change in your health insurance benefits, some other benefits as well, paid time off even, vacation policy, sick pay, all that sort of stuff. A lot of that changes. And when you think about changes to the retirement plan with the new employer from the previous one, you're probably thinking about things like company match or vesting, right? How long until that company match money is yours? Maybe investment choices and those sorts of things. And yet, there is a curveball that impacts your retirement plan when you switch jobs and you have two different employers at some point during the calendar year. That can really create a big issue. And unfortunately, it's a big issue that you don't realize until well after the fact. That's right. It becomes very possible for you to contribute too much to your workplace retirement plan, your 401k through your employer, if you are switching jobs, switching employers during the year. Let me give you an example. Let's say right now, I'm recording, it's late April, and let's say you worked for one company through March and then started with a new company in April, okay? During your time, that first quarter with your first company, you were probably contributing hopefully 15%, maybe 10%, some sort of contribution to your 401k plan. And based on your income, let's say that resulted in, $5,000 of contributions to your 401k. Well, let's say the new job that you start in April, you're making a little bit more money or you're working more hours, something like that. And you look and you say, we're able to contribute a little bit more. So you contribute an even higher percentage and you in total contribute another $20,000 with that new employer between April 1 and the end of the year. Well, here you are now. You don't realize it because you probably weren't paying attention, and the system set up within your payroll department or with your payroll provider didn't trip you out because they weren't aware that you had already contributed $4,000 with a previous employer. Here you are, you get to the end of the year without knowing it. You get your tax documents, you go to file your return, and you contributed $24,000 in total to 401k plans when the limit is $23,500 in the year 2025. So without any awareness or really anyone raising a red flag or saying this could be an issue, you've overcontributed to your retirement plan, creating a really big mess. Well, there's a few different ways that this can materialize, this overcontribution. I'm going to go through 3 of them and then help you with how to fix it. The first is the example I just gave, and let's just use the 401k for example. You go from a company that has a 401k to another company that's also offering the same retirement plan, also a 401k. It goes by the same name. You think, well, they should know, these systems should be able to talk to each other. They don't. So if you had a 401k with your previous employer and have a 401k with a new employer for that calendar year where you've got 2 employers, you've just got to monitor your contributions yourself. And you can do that looking at your last pay stub. I wouldn't wait for your W-2 to come out because by that time, you're not going to get your W-2 until the end of January or in January. And yeah, you've still got some time to fix it. I'll share that in just a second, but it's after the calendar year. And so you want to avoid the problem to begin with, and therefore, look at the last pay stub from your previous employer, see how much you contributed to your 401k through that previous employer, and align your contributions to your 401k with your new employer so that you don't reach or exceed the total limit for the year. Many people think, well, I had 2 different employers, so therefore I can contribute $23,500, to each of them, and I'm not going to contribute that much, so I'll be fine. No. They share the same contribution limit, $23,500. If you're age 50 or older, you can do a catch-up contribution of $7,500. And again, don't forget the new super catch-up contribution starts this year as well. So that's the first scenario. You switch from one employer to another. They each have the same retirement plan. Say it's a 401k. So how do you fix it? As soon as you find out, and ideally, it is it's either before the end of the year or before your tax filing deadline, you notify your HR team or your benefits department. They're either going to handle it for you or they're going to connect you with the plan administrator. There's likely going to be a few forms, if not maybe just one form that you'll need to fill out, basically saying, listen, I did overcontribute. It was this much that I overcontributed total to my 401ks. So therefore, please withdraw that amount out as an excess contribution and draw that amount as well as any earnings from those dollars out of my account as well. Once you fill out those forms or complete that documentation with your plan administrator, your HR, your benefits team, then you're likely to get a couple of forms. And one is going to be an amended W-2, because you're going to need to make sure that your W-2 is correct and you're not reporting too little of taxable income or whatever. So you're going to need an updated W-2. And then as well, you're going to get a 1099, basically a tax return, a tax form that shows income for the amount of investment earnings that you had. That is if you catch this early. And ideally, you're able to catch it before the end of the year and you can fix it even easier, or before your tax filing deadline and you can fix it and then get that amended W-2 and that 1099 form. However, if you don't do your taxes on time or you're not aware of this change and you don't catch this error until after April 15, after your tax filing deadline of the year after that you made the contribution, the overcontribution, it gets even harder, messier, and even more taxing to fix. So best is to avoid that altogether. Be aware of this and monitor it on your own, but work with your plan administrator, and then of course doing tax planning with your CFP as well. Second scenario is you switch employers, but they don't have the same retirement plan. So let's say you switch from an employer that had a 401k and you go to a company that has a simple IRA. Why is that any different? Well, because the 401k and the simple IRA have a different contribution limit. In 2025, the 401k has a max contribution limit of $23,500, whereas the simple IRA has a maximum contribution limit of $16,500. So here's a little bit unique, and you need to be more aware of this when you're monitoring, well, how much did I contribute this current calendar year, tax year with my previous employer? How much am I able to do with the new employer? They're going to share the higher contribution limit. So in this situation, if you're shifting from a 401k, a company with a 401k to a company with a simple IRA, the total, the maximum that you can contribute for the whole year is $23,500. But you can't exceed the contribution limit for either of those plans. Okay, so for example, if you've already contributed, $10,000 to the 401k with your previous employer, and then you switch to a new employer that has a simple IRA, instead of contributing the full $16,500 to the simple, because combined with that $10,000 you already did, that'd put you at $26,500 above the total, the maximum limit to the 401k, you'd be limited to just the difference so that your total contributions didn't exceed $23,500. So gets a little bit more complicated, a little bit more math is involved and geekiness is involved, but that's the second scenario, shifting from a company, an old company that had a different 401k than your new company. And then the final overcontribution issue that we see actually even more frequently than 401ks doesn't have to deal with retirement plans at all, actually has to do with health savings accounts. That's right, there's a couple different ways to contribute to a health savings account. And in order to contribute, you need to have an high deductible health insurance, a qualifying high deductible health insurance plan. But if you're switching from a company that has a qualifying high deductible health insurance plan and you've contributed to the HSA there, and then you switch to a new employer and they also have an HSA qualifying plan, you need to be aware of making sure that combined between the two, you don't contribute even more than the annual limit to the HSA. For 2025, that's $4,300. If you have individual coverage, $8,550 for family coverage, or if it's more than just you. But here's why the HSA is even more common in overcontribution when switching employers. Because your employer contribution counts towards that total contribution limit. With a 401k or even a simple IRA, a company match does not count towards those limits, and therefore it's a little bit easier for you to track just looking at your pay stub. However, with HSAs, the employer, if the employer makes any contribution to your HSA, that actually counts towards that limit of $4,300 or the $8,550. So you have to be aware of not only what you contributed with your previous employer, but also what they contributed. And then you need to be aware of what are you contributing with the new employer, as well as what the new company is contributing as well. There's more math, there's more to juggle, and there's more to be aware of to make sure you stay below those limits. And how to fix that? You just need to make sure that you don't over deduct. Do not deduct more than what you are more than the maximum amount, but then also withdraw any excess contributions that you did. Some HSAs will require a return of excess contribution. Others, just make sure you withdraw the money, and it can be a little bit simpler than the 401k, but make sure you catch that in time as well, because if you let that slip past your tax filing deadline, that can also create even more issues as well. Best planning is to avoid all of this completely. Be proactive in working with your CFP. Your CFP, who's going to help you with this job change and looking at all 6 areas of your financial life, they should be able to catch this and make sure that you avoid any risks of exceeding these limits, but ensuring that you contribute as much as you possibly can because of their tax planning and cash flow planning. They'd be able to help you with this and avoid this completely. So work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online. Korhorn.com, that's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go on and take your next wise step in your financial life.